This chart reveals the systematic overconfidence of economic forecasting. The International Monetary Fund's growth predictions, measured against actual outcomes across 63 countries, show average errors of over 1.5 percentage points just 1 year ahead. In recession years, the IMF correctly predicted the direction of growth barely more than chance. The range of outcomes consistently exceeded the stated confidence intervals. This is not a failure of effort, it is the irreducible property of forecasting complex adaptive systems. On September 15, 2008, at 1:45 in the morning, Lehman Brothers filed for bankruptcy protection. The firm had $639 billion in assets and $613 billion in liabilities. 25,000 employees. 158 years of institutional history. Within hours, the Reserve Primary Fund, one of the oldest money market funds in the United States, announced that its net asset value had fallen below $1 per share. It had broken the buck. The fund held $785 million of Lehman commercial paper, now worthless. Money market funds were supposed to be as safe as cash. Investors had placed their savings there specifically to avoid risk. The news triggered immediate runs on money market funds across the system. In the days that followed, the commercial paper market seized. Interbank lending froze. The federal funds rate spiked as banks refused to lend to each other overnight. The crisis that had been visible in slow motion for 18 months, rising subprime defaults, collapsing structured credit products, Bear Stearns' failure in March, had become systemic in a single morning. The question that would be debated for years was whether Lehman could have been saved, or whether its failure was the consequence of a system that had grown too complex to manage. The 2008 global financial crisis was not primarily a crisis of household mortgages. It was a crisis of the financial architecture built on top of those mortgages, a shadow banking system of $12 trillion operating with almost no regulatory oversight and no lender of last resort. The originate-to-distribute model had separated mortgage lending from mortgage risk. Banks originated loans and immediately sold them into securitization vehicles. The securities were then sold to money market funds, pension funds, and insurance companies globally. At each stage, the instruments became more complex and the underlying risk more opaque. When house prices stopped rising in 2006, the assumptions embedded in every level of this structure broke simultaneously. Mortgage default rates exceeded model predictions. Structured products that had never been stress-tested failed. Rating agencies that had given AAA ratings to instruments that deserved none faced questions about their independence. And insurance products, credit default swaps, that were supposed to redistribute risk had instead concentrated it in a handful of institutions, most notably AIG. The tools available to the Federal Reserve and Treasury had been designed for a banking system of regulated commercial banks with transparent balance sheets. The system they were dealing with in 2008 operated in the dark, repo markets, asset-backed commercial paper, money market funds, and had no legal framework for resolution. On October 13, 2008, 9 bank chief executives were summoned to the Treasury Department. Hank Paulson presented them with a one-page term sheet. The government would purchase preferred equity in each of their institutions. The amounts were not negotiable. The terms were not up for discussion. The meeting lasted less than an hour. All 9 signed. The Federal Reserve deployed facilities that had never been used in the history of American central banking. The Commercial Paper Funding Facility. The Term Securities Lending Facility. The Primary Dealer Credit Facility. At their peak in December 2008, these emergency facilities had approximately $1.5 trillion outstanding. The Fed's balance sheet rose from $900 billion to $2.3 trillion in 4 months. Congress passed the $700 billion Troubled Asset Relief Program, which then, in a pivot that surprised everyone, was used primarily to purchase equity stakes rather than troubled assets. The American Recovery and Reinvestment Act added $787 billion in fiscal stimulus in February 2009. 3 rounds of quantitative easing eventually brought the Fed's balance sheet to $4.5 trillion. Interest rates were held at the zero lower bound for 7 years. The response was unprecedented in scale and speed. It was also incomplete. The fiscal stimulus was smaller than most economists believed necessary, and the recovery was the slowest since the Great Depression. The 2008 crisis response prevented the Second Great Depression. That is the baseline, and it matters. The bank-run cascade that Bernanke, Paulson, and Geithner feared, banks failing, depositors losing everything, credit markets permanently frozen, did not happen. The financial system was stabilized. GDP bottomed out and began recovering in mid-2009. But the recovery was deeply unequal. The top 1% of American households captured 91% of income gains between 2009 and 2012. 7 million households were foreclosed. The scarring effects on young workers who graduated into the crisis, studies showed persistent wage penalties of 8 to 12% extending a decade into their careers. The institutional response was genuine. Basel III increased required capital ratios and introduced liquidity requirements. The Dodd-Frank Act created the Financial Stability Oversight Council and the Consumer Financial Protection Bureau. Annual stress tests became standard. The systemically important financial institutions were identified and subjected to enhanced supervision. But the distributional reckoning did not occur. 0 senior bankers were prosecuted for conduct related to the crisis, compared to over 800 prosecutions following the savings and loan crisis of the 1980s. Foreclosure relief for struggling homeowners was underfunded and poorly administered. The political consequence was a decade of populist anger directed at institutions that had been bailed out while households were not. The housing bubble that produced the GFC was inflated, in part, by the interest rates cut to contain the dot-com recession, episode 12. Every policy tool that successfully addresses one crisis contains within it the mechanism for the next. This is not a failure of policy. It is the structure of financial history. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic Crisis Explained. 2026.